All right. I have heard you speak about revocable trusts. Can you tell us the difference between a revocable trust and an irrevocable complex trust? Well, the spelling, obviously. I know you, I know you have said that. With an irrevocable, you don't use anything, but wouldn't you, or that you don't own anything, but wouldn't you want to, wouldn't you want that so you can't get sued? So let me make sure I understand this. I know you said that with an irrevocable trust, you don't own anything, but wouldn't you want that so you can't get sued? All right. Jeff, what do you think? We'll break this into two pieces.
So the
first part.
Revocable trust is your typical grantor trust, living trust. You can call it any number of things. It really doesn't mean that much until you die. You can place assets in the revocable trust, but you can also take the assets out. So they're never permanently there until you pass away.
They're going to be taxed as a grantor trust.
Yes.
So revocable trusts, there's actually rules that say even if it's an irrevocable trust that has the ability to change and swap out beneficiaries and things like that, they're still going to say that's a grantor trust, which means the trust doesn't exist for tax purposes. It's going to go to the grantor.
Yeah, that's a great point. So my $1 million of stock that I put in my living trust, that's still being taxed to me.
Mm-hmm.
The dividends
in your living trust, your revocable trust, land trust, personal property trust, they're all grantor trusts. We could also set up a Nevada Asset Protection Trust or Wyoming or South Dakota or in Alaska or Delaware, whatever you want to call it. You could set it up. And if you have the right to switch and change the beneficiary, it's a grantor trust. It's called an intentionally defective grantor trust. It's still an irrevocable trust, but it is defective for tax purposes, meaning that it's ignored. We do that too a lot when we're just using it for asset protection. So the irrevocable nature of it, if we create an irrevocable, is what's the asset protection tool. For tax purposes, there's other things we look at. Can you switch it? Can you swap things out? Can you take a loan against it that would destroy you, whether it's a complex or there's another term called simple trust, which we'll get into a second. So the difference between a revocable trust and an irrevocable complex trust is this. A revocable trust is ignored for tax purposes. It can be changed. An irrevocable trust means you cannot make changes to it. And it pays its own tax, and you could distribute principal. You're not required to, but you can. A simple or irrevocable simple trust pays its own tax. And by the way, the trust tax rates are horrific. You're at 37% when you make $13,000.
Yep.
Horrific. Simple trust means you distribute all the income on an annual basis, but you can't distribute the principal. So if I create a irrevocable, simple trust, I'm putting money in it, I'm putting it into some assets, and it's kicking off the income. I have all these tax cheats that get out there and they start saying, we're going to set up a tax-free trust. And here's what we're going to do. We're going to take the dividends and we're going to reinvest it and I don't have to pay tax on it. We're going to take all that. And what they're doing is they're looking at a tax code and they don't understand the difference between a simple and a complex trust. And they draft a complex trust that these rules do not apply to. In a simple trust, if let's say you own stock and every year you're paying out the dividend, but your trustee says, you know what, we're getting a one-time distribution, an extraordinary dividend of a bunch of shares. It's kicking me out Warner shares, and I don't want to pay tax on that. I could apply that to the corpus in that particular case, and I don't have to pay tax on it without distributing it. Can't play that game with the complex trust, which what these bozos are always trying to do. And then I'm always like having to give bad news to people that no, you can't run your business through a trust and never pay tax on it. But he told me you can. Yeah, they're completely wrong. But here's what it is. The difference between the revocable trust is it goes down to you from a tax standpoint. In an irrevocable complex trust, in a complex trust, if there's any income left that's not distributed to you, is taxed at the corporate rate. If it's distributed to you, it keeps its nature. So it could be long-term capital gain, short-term capital gain, interest income,
Mhm.
ordinary income. And then an irrevocable, if it's in a good jurisdiction and and it's well drafted, it'll be almost impenetrable from creditors of yours because you don't own it, right? If you are in control of that puppy, now we broke it, and more than likely it's going to be a grantor trust. And then you better have good statutes like Nevada to protect it. Anyway, sorry. I just
one other thing I wanted to bring up, and a difference between a revocable trust and irrevocable trust is, let's say I put 100,000, my cost and my assets about 100,000, fair market value of $500,000, and I put that into my revocable trust. I die, my beneficiaries get the stepped up basis. They get the $500,000 basis, not the 100,000 basis. Whereas in the irrevocable trust, if I put that same $100,000, my cost, and it's worth $500,000, their basis is 100,000 because
Correct.
it's considered a gift to the trust.
The trust basis,
The trust basis.
but that would only be if it's not an intentionally defective trust.
Correct.
Right. No, absolutely 100%. That's why you don't play with these things. I don't do, me personally, I could count on two hands how many complex trusts I've put together. More than likely it's going to be an intentionally defective because I want to have the ability to work with it. I do the complex if it's a living trust that's going on, then that's a different animal completely. But we're not trying to get any, at the time it's revocable and then it becomes irrevocable after you pass and everything's already stepped up.
Yeah, a complex trust allows you to control what's going out to the beneficiaries or whoever's the trustee. Whereas a simple trust, it makes money, it gets passed on to the beneficiaries and they deal with the taxes.
Somebody said, I did a trust because I thought it would take everything out of my name. Not. They can actually be pretty effective, but it might flow onto your return. And then the only question is whether somebody could see that.